Good evening, everybody. Let's get started. So, hope everybody had a very Merry Christmas. Everybody looking forward to the new year. I know the new year is always an exciting time. It's kind of a time of renewal. Everybody thinking about the future. You know what? It's a great time to be thinking about your finances, think about retirement. Don't look at it as a New Year's resolution. I don't think of it. It's not a resolution. It's something that you have to do. It's a great time to take inventory of where you're at, analyze, redo, or just kick it off if you haven't done it, yet. As far as retirement planning goes, it's a great time to do it. So everybody, hit me up with a hashtag live or hashtag replay down in the comments. If just tell me how you're watching. Of course, any kind of comments or anything you want to comments or questions, whatever, hit me up down below. Like I said, this is the time of year. It's great to be thinking about getting back on track for your retirement plan. And if you have one in place, get time to review. If you don't have one, doesn't matter how old you are, how young you are, if you've started or you haven't, you got to have a plan, right? So let's take the new year and get vested in making sure we have that taken care of. We're here, of course, to help out. So tonight we're going to talk about when life gets in the way of your retirement plans. So has anybody ever had your life not go quite as planned? Have you ever had things change or get in the way or things that come up that alter your plans? It happens in retirement as well. It's like Mike Tyson famously said, everyone has a plan until they get punched in the mouth. Well, just like in boxing, retirement planning can be that same way. Everybody may have some plans laid out. Life happens and doesn't go quite according to plan. So, even with that though, in your planning, for your retirement, you have to account for those unknowns. I know that sounds kind of strange. How do you account for the unknowns? But there's ways to do that in your plan as best as we can, right? So before I dive in, I do want to thank everybody that is joining. Thank everybody that is new to the group, and also those who participated in the poll as far as topics that you guys want to hear and talk about here in the group. If you have not taken that poll, please go into the Facebook group page, scroll down, and you can find the topics. I think I also have it pinned up top as well. If you haven't already voted, take a vote on there. We have some good topics. If you don't see one that you like on there, there is a space to write one in. So if you have not done that, please do so. We'll be taking all those and getting to all those in the new year, as well as other great content that we have planned for you guys. So take a moment to do that. Just takes a second. Appreciate it. So let's dive in when life gets in the way of your retirement. So life, Life. Let's take those one letter at a time. So L, we're going to take L for longevity. One of the biggest challenges in retirement is making sure that your money lasts, that you don't outlive your money. There was a post out there the other couple days ago or last week that I put out there about the 6 main risks of retirement planning. And if you want some information on that, just go back to that post, hit me up in the comments there, and we'll send that out to you. But that's a big challenge. Longevity is one of the biggest risks. There's 2 big risks out of those 6. All 6 of them need to be accounted for, but 2 of those of those 6 are bigger than others. One of them being longevity. The majority of Americans underestimate their life expectancy. We're all living longer, right? We mentioned earlier that retirement today is not like our parents or grandparents. We have to account for that. So it's not like we're only going to plan for 10 years in retirement. At least 20 years on the conservative side, or to be on the safe side, should account for 30 years, right? We don't know how long we're going to last. We don't know how long we're going to be here. We don't know when Jesus is coming back either. So we need to factor in for as long as possible. Okay. There's ways to minimize longevity risks. Obviously, you can put more money into retirement savings, but what if you don't have an extra whatever amount that you need? There's some things to do to help at least cover the bases, right? We talk a little bit about that more in some other sessions. So longevity. That's one of the things that can get in the way is I live longer, right? Hopefully that's the case. You live longer, but you got to account for all the different things. So living longer takes on a lot of different things. One of them we're going to touch on here in a bit. So then we move on to I's from inflation. Anybody felt inflation here over the last couple of years? Yeah, it was pretty high, wasn't it? It was at some record highs. It has been coming down. The reports are looking a little bit better, but there's always going to be inflation, whether it's low or high. Even a 2% inflation rate is going to affect how much you can buy tomorrow versus today, especially when you're talking about in your retirement, which is off in the future. You got to account for what the dollar is going to be worth and what it's going to cost down the road to buy things versus today. That's definitely going to factor into how much income and wealth you have. to paying yourself. When I say income, I mean your retirement income to yourself, and you got to account for inflation. There's ways to hedge for inflation in your plan. A lot of people we hear, well, you got to be more conservative in your investments in retirement. That's true. You start shifting into protection mode, a little bit less risky. But if you've listened to some of our other videos and trainings that we've talked about of the different phases of retirement, the different buckets, the different stages, um, it has to be diversified, but it also has to account for those different stages and phases. All those have different investment types that you get into, and they have different purposes. And the longer range ones, you can be a little more aggressive with to help fight inflation. We can dig into that a little bit deeper, but you have to account for inflation. Inflation can definitely get in the way. F is for fluctuation. Everybody's seen the market go through that roller coaster up and down. And even though over the long haul, the market's like this, but you have those fluctuations that are going throughout it. And, depending on when you get those fluctuations hitting you, could have a major impact on not only during your accumulation phase of how much money you have and able to spend or save up rather, but in your retirement, within the first couple years of retirement, especially the first 5 years of your retirement, there's a thing called sequence of returns risk. I've talked about it before. We're going to go a lot more in depth in it in a future session, but you got to account for this because you have to protect yourself. There's ways to protect yourself because if you have funds getting drawn out of your account and it's the market's going down at the same time and your accounts are going down from a return standpoint, it's devastating. You got to account for those fluctuations. People say, "Well, hey, I can't account. I can't control the market. I can't say I tell them what to do." No, that's very true, but you can account for it. There's the ways to protect yourself against those fluctuation swings and make sure at least your base income retirement is protected, so you're paying your basic expenses. Those fluctuations we can even those out, and we definitely need to do that. And then E is for events. Kind of talked about in the intro here. Anybody have ever things that happened in your life that just didn't go your way? You had some events pop up, unexpected expenses and events that were unplanned that have a material impact on your life and can have a material impact on your retirement plan. One of the biggest things, of course, different events can happen, but one of the biggest things for events is healthcare as we get older and long-term care costs. Um, you know, especially the long-term care cost. But even so, there's a study out there from Fidelity fairly recently that said the average 65-year-old couple will need about $315,000 out of pocket healthcare costs in retirement. That doesn't account for the reduction in Medicare benefits down the road that may come out, or the increase of healthcare costs, right? Or that also doesn't account for long-term care costs. So 315,000 out of pocket, that doesn't even cover long-term care. So as we get older, you got more medical bills usually. And we talked about that retirement smile, and on that backside of that retirement smile, your expenses go up because of healthcare, right? So you got to account for the healthcare in your plan properly. Sure, you might have Medicare, but you're going to have some supplements on top of that to have the proper coverage, or you're going to have even more out of pocket. The other thing, the most devastating, is the long-term care. Now, long-term care is one of the more dangerous things if you don't account for it in your retirement plan. If you don't have long-term care covered in your retirement plan, then you don't have a complete plan. Okay. And by the way, all those other things I just mentioned, if they're not accounted for in your retirement plan, you don't have a complete plan. But the cost of nursing homes and long-term care is huge. In the United States, on average, now this is nationwide, for a private nursing home room, it's $9,000 a month. $9,000 a month for a private nursing home room. Now you can go semi-private, which is a little bit cheaper. A lot of people don't like that though. There are some states that it's a little bit lower, 65 to 7,500, and there's other states that are higher, even higher than 9,000. So the average nationally is about 9,000. By the way, Medicare does not cover long-term care costs. So this is out of pocket to you. People say, well, what about Medicaid? Well, Medicaid does cover some long-term care costs, but one, you have to go into a Medicaid facility. Two, you pretty much have to spend down and liquidate most of your assets, all the way down to about $2,000 before Medicaid will ever do anything. And we don't want you to have that position, right? So we want you to make sure that you account for long-term care, right? We got to take care of that. So those things, LIFE, got to account for all those different things. Obviously, this is just having some fun with the word when life gets in the way. Those are some key things around um, those different letters in life. But okay, what? So we talked about it. So now what, right? Well, here's some things to consider to help with some of those different things. Right now, obviously, each of those things in the LIFE that we just talked about are a topic onto themselves. We'll probably go into a lot of those in this group as we go through. Let's talk a little bit here for a second about some things you can do just to top of mind. And we'll go into some of these deeper as we go through as well. One is making sure your portfolio is diversified, right? Everybody hears that. Make sure your portfolio is diversified. That's a key, right? You can't have all your eggs in one basket. However, we talked about the different phases, steps, and all that of retirement. I frequently refer to the three sets of three. Well, two of those threes are the different buckets and the different phases of retirement. Well, each of those buckets and phases, one, are funded differently. They use different investment vehicles and they're used differently, right? Well, even inside each of those buckets and phases, you can diversify, right? So you got some natural diversification across those different phases, but even inside those, you have to be diversified to account for the different ins and outs that can happen in the market, and also have the proper levels of protection in the right funds. Okay, make sure you're properly diversified. Consider purchasing long-term care insurance or factor the cost of long-term care insurance into your plan and have it be self-funded. Long-term care insurance can be a little pricey, can be a little tricky. It's gone over some changes over the last year or so. A lot of people have even gotten it. Some carriers have gotten out of it, but it's worthwhile for some people. It's not the right answer for everybody. If you can afford it, that's great. There's also a timing issue as far as when you buy it, because you buy it too young, you're paying into it forever, even though the premiums are lower. But over the long haul, you're going to be paying more premiums. If you wait too long, premiums are going to be higher. But there's some good options out there, and it's something to consider to look at. The other thing is self-funded into your retirement plan. So you would have to account for the cost of long-term care in your overall goal, which you need to save for retirement. That obviously increases your goal a little bit, but there's also some different investments and things you can get into that have long-term care riders on top of those products that will then help pay out or allow you to withdraw funds down should you need long-term care. Okay, so we need to account for that in your plans as well. Figure out which of those methods is the right way to go. Pay off your debt in retirement. The goal would be to pay off your debt in retirement entirely, including your mortgage. But what we recommend and what we tell our clients to do is pay off all your debt except for your mortgage first. You know, credit cards, cars, all those different things, and then work on paying off your mortgage. Yes, pay off your mortgage for retirement if you can. Right, the tax benefit for the write off of the small little bit of interest rate is not enough. The benefits far outweigh paying it off. Okay. Then you also have equity in your home. You own it outright. If you get into a situation where you need that equity, then you have it, right? But that way you have that cost off the table as well. You don't want to worry about all these different debts in retirement that just increases your minimum need every month. So the goal would be to get out of debt. Now, obviously, that's not possible for everybody. It needs to be accounted for in your plan if you have some. Um, just needs to be factored in. Estimate your pension and retirement income and also factor in taxes. Well, most people don't have pensions nowadays. A lot of people don't. It's going away. Only about 7% have pensions. And those are every day, more and more of those are going away. Like I said, today's retirement is not like our grandparents and parents. So, yes, there is a way to create your own personal pension. Hit me up. I can explain that, what a personal pension is. Um, and then also, though, what's your retirement income? How are you replacing your paycheck to pay yourself in retirement? What's your retirement income look like? How are you doing that? From what products, from what investments? What's the drawdown methodology? You know, in one of our other videos, we talked about the drawdown strategies, and that has to be part of your plan. Um, Everybody thinks about the accumulation phase. You got to think about the disbursement phase, the drawdown phase as well. And then how do taxes play into that? As you withdraw funds out of your different retirement accounts, it has tax implications on how and when you take those out of what accounts, and also the impacts it has on Social Security and Social Security benefits being taxed. So those have to be accounted for in your overall retirement income plan, right? There's retirement income planning. Part of to do that though is you have to estimate your expenses. That's another thing. Look at your expenses now and try to estimate what they're going to be in retirement. Some people say, "Well, it's too far off. I can't think about what that's going to be." Yeah, we can get to a pretty good idea. We have some ways to tips and tricks to do that, to hone in on what your expenses are going to be, because you want to make sure those core expenses are covered. You want to make sure they're covered with some protected assets, some protected investments. That's part of the staging and the stacking of your assets the right way. Um, estimate your expenses. And then, based on all the information we just talked about, run your retirement analysis, right? Not just go, well, you can go to a website and put in all these numbers and come up with this retirement calculator, come up with this one big number, right? That's only a starting point. That doesn't account for all the different things we just talked about. If you go to my video where we talked about retirement, are you ready? You can find it out there on the page. It doesn't account for all those different factors, but it's a good starting point to figure out what your total is. That total will probably be adjusted though once we get into the details of the proper plan that's personalized for you. Okay. That's going to be different for everybody. Right. So you got to do an analysis. Sure. Do the calculator if you want to do that. Highly recommend working with an advisor to figure out to do the proper analysis for you or with you, I should say, to personalize it and figure out and account for all those different factors. Right. You can do it on your own. You just got to account for all these different things. And I'm going to share with you probably the first of the year, even if you are a DIY kind of person, um, some tools that you can use to do that. Okay. And then, so you run your analysis, that'll help you put together the plan. And then determine the actual drawdown strategy. I just alluded to that earlier. You can have your money, what your needs are, then you got to figure out the income and drawdown strategy. How am I taking it down? When am I taking it down? Funds out of different accounts at what time, how much, and what accounts. Okay. So let's try to eliminate or at least reduce and account for all those different life fluctuations because life certainly does get in the way. And it does get in the way of retirement as well. So you got to be ready for it. So again, guys, if you haven't taken that poll, please go out there and do that. Let me know what some topics are. Put some comments down in the comment section that helps us out on the Facebook algorithms. Also, I'd love to hear from you guys. Comments, questions, concerns. That'd be great. Hit me up with some questions. If you don't feel like putting them in the comments, hit me up on direct messenger. We can do it that way as well. So this is the final one for 2023. Looking forward to 2024. We're going to dive into some of those topics you guys voted on the polls with a lot of other content that we have planned for you guys, both on the lives and just postings into the page. So I'm excited about it. We're also going to be talking about and announcing some um, things in the new year as well as some exciting new offerings. We do a lot of planning for people. We have a lot of success stories of doing proper and comprehensive planning for our clients. We have an exciting coaching program for the DIYers that can, if you don't want to come on as a full time client and whatnot, there's a coaching program that may be right for you. So hit me up with any questions you have about that. It's exciting. It's new, and we're expanding that out. It's pretty cool stuff. So happy to answer any questions about that. Well, hopefully we can have you become one of the next success stories like we have with so many of our clients to have this comprehensive and complete plan, whether it's doing it with us personally, doing it on your own with our help, or going through the coaching programs. Hit us up. We're probably going to have some specials in the new year as well. So until then, happy new year. We'll see you next week as we dive in and look forward to those announcements. Y'all have a great one. Take